Hello and welcome to another episode of the Bitcoin Standard Podcast. Our guest today is Lyn Alden. Lyn is an economist specializing in global macroeconomics, currency markets, and equity valuations. She runs her own website, lynalden.com, LYNALDEN.com, which provides retail and institutional investment research services. Lyn first got into writing about cryptocurrencies in November 2017 and made her first investment in 2020. In July 2020, she wrote a widely circulated article on Bitcoin entitled 3 Reasons I'm Investing in Bitcoin, and it was a pretty solid and clear statement of the investment case for Bitcoin, I think. Lyn is also an engineer, an electronic engineer by training, which explains why she understands Bitcoin so well, because I think engineers are naturally likely to be better at getting Bitcoin and how it works. So as somebody who studied in engineering, although I never really worked in it, I still like to count myself as among the engineers. And so I always like to stress on this point. So Lyn, thank you for joining us.
Thanks for having me back again. Happy to be here.
Yes, we've had Lyn before, which was a very interesting conversation, and we'll post the notes to your first interview here. So you're one of the people who I think follows the macroeconomics and Bitcoin in a very competent and well-researched and very reasonable way. So your analysis of Bitcoin and your analysis of the market, I think, are quite valuable. So that's why I always enjoy talking to you and seeing what you have to say on global macroeconomics. This has been a pretty eventful week in global markets, both digital and analog, with pretty bad drawdowns happening across the board pretty much everywhere. And all because of supposedly the Fed engaging in tightening monetary policy. The Fed's made noises about tightening, and they haven't tightened yet, but the markets are already reacting as if they are going to tighten. So what do you think of this? What do you make of this so far?
Yeah, so I think we can zoom out and focus on the big picture, focus on the micro picture. So in the very kind of big picture sense, because of how much debt is in the system, the Federal Reserve has a really tough time raising interest rates. Basically, they lowered interest rates so much through so many cycles that they encourage so much debt to build up in the first place. And so they kind of trap themselves into a corner where it's very hard to tighten monetary policy without basically burning everything down. And so they made a decision last year, before ever since 2012 or so, they've had this target of 2% inflation, the way they measure it, CPI. Actually, they use a similar metric to CPI. But anyway, they want to have 2% inflation. And starting last year, they talked about how instead of making that kind of a ceiling, they were going to kind of make that like an average. They wanted to purposely overshoot inflation and basically err on the side of continuing stimulus. And that kind of came back to bite them, I think, pretty quickly, because they were hoping to get maybe 3-4% official CPI. And instead, we have 7% CPI and still technically inching up here. And so the Fed, they were insisting that inflation was transitory, but once it started to hit those rather alarming headline levels, 30, 40-year highs, they changed their tune pretty quickly, and they started talking about, pulling back on quantitative easing, raising interest rates, and potentially even doing quantitative tightening. And the challenge is that they partially kind of missed their window because, if you look at, say, indicators of economic activity, right? So, for example, if you look at purchasing managers' indices, it's kind of a rate of change metric for what the economy is doing. When it's over 50, it means that basically it's expanding. When it's below 50, it's contracting, but it also gives us direction. So, for example, if it goes up to 60 and then falls down to 55, it's still growing, but it's decelerating. And generally, if you look at the purchasing manager index, the PMI over the long term, it looks like a sine wave that kind of bounces around 50, generally between 60 and 40, and sometimes you get these crazy spikes or dips. And so as we enter 2022, PMIs are rolling over. And these tend to have roughly 3-year cycles. I mean, you can have a couple different PMI cycles in in something that's defined as an economic expansion, because you have these ebbs and these flows. And the problem now is that the Fed is looking to tighten into a decelerating economy by most indicators. And we had a similar effect back in late 2018, right? So when they were raising rates in 2017, They had the backdrop of, rising PMIs. They had, the fiscal authorities were doing tax cuts on the horizon. So you essentially had a form of fiscal stimulus, basically cutting taxes without cutting spending. And so they had that kind of stronger environment to try to tighten into. But as that kind of dragged out to late 2018, they started to run into headwinds with that. And now they're kind of starting from a similar position, except they're just starting talking about tightening when PMIs are already rolling over. And so the market's throwing a fit, and then you add, geopolitical risks related to Ukraine, all sorts of, macro things out there, and it's a really tough time for them to, kind of continue on that track. And it's kind of an evidence of themselves painting themselves into a corner.
Yeah, and for people who are inclined to view things from the Austrian perspective, or at least not from the Keynesian perspective, I think the mere fact that we find this combination of them having to ease, or of them having to tighten into a slowing economy, is in itself a refutation of the way that Keynesians think that an economy works. Because according to the way that Keynesian economists think, this shouldn't be possible. This isn't something that should happen, because it's the level of spending that determines everything in the economy. And so if the level of spending is high, then you have inflation along with a growing and overheating economy. Whereas if the level of spending is low, then you have low inflation, or maybe even deflation, but you also have a stagnating economy. So you can't have both a stagnating economy and an inflation, because the aggregate demand is what determines either, and you have a trade-off between the two. So essentially the entirety of Keynesian economics is built on this ridiculous idea that there is a trade-off between unemployment and inflation, and that we can essentially, we can't get rid of that trade-off. We can only pick certain places among these different combinations of high inflation and low unemployment, or high unemployment and low inflation. But they've been down this corner before. Every time, more or less, we see something like this. Like 2008, 2009 was something similar, and yet they continued with the expansionism, with expansionary monetary policy. And inflation was not that bad. Now, why do you think things are, that inflation is so bad this time in particular?
So a couple factors. If you look after 2008, you had a massive amount of leverage in the system. So if you look at, say, the U.S. financial markets, if you look at total debt compared to the monetary base, it was a multiple of about 64. So you had 64 times as many claims on base money as there was base money. You could also look at broad money supply to base money. I forget the exact ratio, but it was pretty high. And then what they did in the 2008 crisis and in the aftermath is they mostly recapitalized the banking system. So they created new base money out of nowhere. They bought treasuries from banks, but then they also did, combining with fiscal authorities, they did the troubled asset relief program. And so they basically, help the banking system be more solvent. But what they didn't do is bail out homeowners for the most part. So there were minor fiscal stimulus packages, what we'd call minor today. I mean, it was several $100 billion. But basically, if you looked at, say, broad money supply, you had a destruction in loans, right? So you had a contraction of money supply, but then you also had stimulus. And so if you looked at broad money supply, it was roughly flat throughout that crisis. Basically, you wouldn't even know there's a crisis if you're looking at broad money supply. And so basically there wasn't like a ton more money in people's bank accounts chasing fewer goods and services. You had basically most people had less money. Many people lost their homes. They had to contract spending. There was high unemployment. In this cycle, there were a couple things that were different. One is that the fiscal stimulus was much larger and quicker right off the bat, and banks already went into this crisis well capitalized. They already had high amounts of reserves and treasuries as a percentage of their assets. And so they have other, there might be other challenges out there, but they weren't in the same situation they were in 2008. And so the goal wasn't to just recapitalize the banking system and not everyone else. It was more of that broad base, setting up like PPP loans to turn into grants, bailing out the airline industry, sending checks to people, doing childcare tax credits. Everybody, the majority of people had more money in their bank accounts. So broad money supply itself went up far more dramatically. It was the biggest spike we've seen since World War II, when you had a similar inflationary effect, by the way. And so this time it resulted in more money chasing, the same or fewer goods. Then you also add, supply chain issues, lockdowns, things like that. And another big factor that almost no economists pay attention to is the natural resource cycle. If you look at, just they always focus on the demand side. They don't really focus on the supply side. And commodities go through these kind of like 15-year capex cycles roughly, where you have this period of oversupply. So you have super low commodity prices. Nobody wants to invest. And that's, they shouldn't be investing because it's just not, as you'd be destroying money. And over time, demand keeps going up over time, and then existing supplies get dwindled. You eventually get tighter commodity markets, and then you get a price signal, you get higher prices, and then it overshoots, of course. And then because there's a lag time between how you can bring more commodities online, money starts going into it, and it kind of works that self out. And so during that whole decade after the global financial crisis, we were in a period of structural commodity oversupply for the most part. You had demand destruction, and then you also had just, China slowed down. So all these copper mines came online during the whole emerging markets boom in the 2000s. And so suddenly we were kind of oversupplied on a global basis. And US shale oil brought a lot of new oil to the oil market and, destabilized that whole kind of supply demand balance that OPEC was trying to maintain. And so we had this period of oversupply, especially from the 2015 to like 2020 period. You just had oversupply of oil markets in particular. But a lot of that's worked out now. The combination of investors don't want to keep lighting their money on fire, so they're basically requesting more discipline from, say, shale oil producers. In addition, you have ESG mandates, things like that. So there's not a lot of excess capital going to energy capex anymore. It's been very low. And so now we find ourselves in a much tighter natural resource market. So the combination of faster money supply growth and then all sorts of physical constraints on supply, give us a much more inflationary environment, I think, in this decade compared to the prior decade.
I wonder, though, how much of that is really just monetary policy. I think the real distortion here in commodity markets is that investors all over the world want to hold commodities as a hedge against inflation. And so a lot of investors will hold industrial commodities on their balance sheet. So you can understand you can understand the case for gold. You could maybe, at a stretch, make a case for silver as a monetary commodity, although I would disagree strongly and say it's an industrial commodity. It's the original shitcoin that's been demonetizing for 150 years. But unless you're involved in copper or zinc or platinum, there's really no case for holding any of these industrial metals. They're purely industrial metals. I think in a normal market, I don't see that normal people would be holding these as part of their well, when I say normal, I mean one with a hard money. If we had a decent hard money that people could hold as a store of value for the long term, I don't see why they would want to hold these industrial metals. And so I think the market for these is maybe heavily distorted by the excess monetary demand for all of these otherwise industrial metals that should be held, that should only be held by people who have industrial uses for them, and would not, you can imagine there would be experts using them, experts who follow the market, trading the market in order to benefit from supply constraints. And that's how the market functions smoothly, because people make guesses, and then the ones that make good guesses do so by moving essentially the metal from a place where it belongs to a place where it doesn't. But holding it as a store of value, just putting a bunch of metal on your balance sheet is likely very distortive of the markets for those metals. So when you say commodity cycle, do you think that that's something that's part of the nature of physical resources, or would you say that's likely an example of monetary manipulation and fiat disease?
I think a little bit of both, because I think that commodity industry is a very tough business, and it's because it's one of the few industries where you can't really control the price of your own product, and because it's you don't really have differentiation compared to competitors, and so it's somewhat inherently more subject to volatility than other industries. But then speculators do kind of amplify the tops and the bottoms of that market compared to what it otherwise would be, especially in a sound money environment. But if you look at the current environment with energy, for example, energy's got a very low stock to flow ratio. There's not many months worth of storage around. And so part of the energy shortage we've been seeing is that, for example, natural gas storage in Europe and Russia has been relatively low. We're also seeing drawdowns in oil inventories in the United States and elsewhere. And so for example, the shortages that we're seeing in the energy markets are mostly not driven by speculators. It's really about the consumption versus production. Basically, production's kind of flat compared to pre-pandemic. If in some places down. So, for example, U.S. production never got back as high, and it really shouldn't have, because some of that was, a lot of that production only came online because of those easy money policies. Basically, the combination of super low interest rates allowed and a kind of continual investment by pension funds into those things. That's where I think the manipulation was more prevalent. So that whole decade, part of, ironically, why you had disinflation was you had a lot of malinvestment kind of just going into the oil patch, basically lighting itself on fire, but providing a good amount of oil. Most of those companies were free cash flow negative throughout that whole cycle. And then so that started to change around 2018, 2019, but then they got hit by, the whole lockdown pandemic, things like that. So then they got slammed in 2020. They kind of doubled down on being very conservative with their CapEx. And so now we're in an environment that's more normalized, where you actually have kind of a tighter supply demand balance. And so I think a lot of people, they kind of have recency bias, and they look back over the past decade and they say, oh, look how disinflationary everything is. We have all the commodities we need. US is like energy independent, but some of that was artificial. And so now going forward, I think we're in a structurally more challenging environment for energy. Some of it's self-imposed, and some of it I think is the natural cycle that industry goes through.
Yeah, I think I think that's your analysis of the energy crisis is arguably spot on, and I think another factor involved there is obviously all of these insane regulations that are being brought to bear on the oil industry. So apparently people think that the carbon dioxide is boiling the oceans literally as we speak, and so therefore we're going to reverse industrialization in order to get rid of, increasing a natural gas in the atmosphere by tiny fractional amounts. But moving back to the Fed issue, do you see them actually going ahead with this? I mean, okay, so the inflation is higher, with a broad money supply growth is much faster. But can they taper? Because this is really the dilemma of the credit cycle. And Hayek has a great book called A Tiger by the Tail. And he says inflation is like holding on to the tail of a tiger. Once you've done it, once you've decided to take the foolish step of holding the tail of a tiger with both of your hands, there are no good ways out. There's no, the only smart thing to do is to just not hold the tiger by the tail. And once you've done it, you're faced with the option of just holding on to the tiger so that the tiger keeps running, trying to escape, trying to get you off of them. And, it's a tiger, so it's going to have a lot of energy to run around and to flail you about and knock you around. Or you could let go, at which point the tiger is going to stop running around and turn to you and eat you and have you for dinner. So I think we see this happening. And if you look at the history of the Federal Reserve, you see this happening really from Greenspan. Of course, it happened in the 1970s, and then they managed to get it sort of under control in the early 80s with Volcker. But then Greenspan started in 1987, or a little bit earlier. Greenspan's expansionary monetary policy started, and it's like an addiction. You think, all right, let me just hold on to their tail a little bit. It feels so nice to try it. And then you just keep getting tempted, and you do it more and more and more. And now, could we be at the point where the tail, where the tiger is in full... that's it. It's coming to an end. Are they going to let go? Or are they going to witness are they going to let the horrific kind of credit market crashes happen? Are we going to see interest rates rise? Are we going to see all of these defaults? Are we going to see a massive inflation or massive recession? Or will they just continue to try and push their luck with more and more inflation? What do you think?
I think they're going to err on the side of pushing their luck with more inflation. So I don't know exactly how far they're going to get with tapering, but I'm going to take the under for the most part, and think that, especially with the declining PMIs and basically overall deceleration, I think that basically they're overshooting their expectations somewhat. And there's a couple, it's more like I think there are certain markets to look at. So a lot of people say, the Fed will never let stocks crash, but there's far more sensitive things they look at more than stocks. And so, for example, during the quarter four 2018, kind of downturn in markets, Powell had his famous Powell pivot, where they were talking about, their tightening policy was on autopilot. And then by the time you got to January 2019, he's like, just kidding, we're gonna be data dependent, relax, guys, because you had everything crashing. And a lot of people have said, hey, look, it took a 20% downturn in the S&P 500 to make him change his tune. But the bigger thing under the surface, that was like the part of the iceberg over the surface. The iceberg under the surface was credit markets. So during that there was like a 6-week period where credit markets froze. No junk bonds were issued for like 6 weeks. And that's a much more severe problem for markets than just the S&P 500 going down 20%. And so that's the type of thing that makes them pivot. And so, just stocks going down 10, 20, 30%, Bitcoin going down, altcoins getting killed, these things are not going to make the Fed pivot on a dime. It's watching credit markets, and then it's also watching if the treasury market becomes illiquid like it did in March 2020. So those are the kind of the bigger pieces of the iceberg that would kind of force them to shift. In addition, if you started to see yield curve inversion, if you started to see actual recession risks rather than just deceleration risks, those are things that would likely lead the Fed to pull back, even if inflation's still above their 2% target. And so, it's been a while since they've had to choose between inflation, at least the way they measure it, and employment. So, normally they're bouncing back between their two algorithmic mandates, basically trying to maximize employment, trying to keep inflation, near their target, and usually choosing one or the other. Back in the 70s, they had both were problematic, and so Volcker chose to kill employment to try to stabilize the dollar. And I think now, and the difference was that they had a lot of problems back then, but they had low debt to GDP, partially because they had already been inflating it away, throughout the 40s and then throughout part of the 70s. And so they had low debt to GDP, and so they could jack interest rates pretty high without causing widespread insolvency. It caused a severe recession. It didn't cause like a depression. Whereas here, because you have so much debt in the system, I think they're going to err on the side of letting inflation run over their 2% target, and trying to jawbone it back down, trying to manage it around the margins, but still letting it run hot. And that's essentially what they did back in the 40s, which is the only other time federal debt to GDP was as high as it was now. I mean, we had these big inflationary spikes. You had price and wage controls, and they just held rates at zero for that entire decade, because they basically recognized insolvency. And so I think that's the framework going forward, but it's not necessarily a straight line. And so I think they're going to try to slowly tighten here, until they get some of these signals that say you're stuck, basically, because kind of their third mandate is financial stability. So if the repo market breaks, if the treasury market breaks, if credit markets break, they're kind of forced back in to reliquify whatever market that was. And so that's kind of how I'm monitoring it.
Yeah, I tend to agree, and we had a similar answer from Parker Lewis, whom we spoke to last week. I think what it really comes down to is that the political forces that are going to push for inflation are infinitely more powerful than the political forces that are going to push against it. So if you get inflation, it's going to be good for borrowers. It's going to be good for the biggest borrowers in particular, and so. The US government, the largest corporations, they're all going to want to keep continuing pushing for more of the addiction, essentially, that continues to that continues to require more and more money in order to keep the house of cards standing. On the other hand, they can still play around with CPI numbers. I mean, they've been playing around with CPI numbers since the 1970s. Prices of things just keep going up, and it's quite astonishing to see how people just normalize the idea that prices go up because of reasons, and all of this money supply is irrelevant to it. Prices only ever go in one direction, and the money supply ever goes in one direction. But we've had 50 years of fiat economists staring us straight in the eye and telling us, no, well, actually, correlation is not causation, and the money supply does not cause prices to increase. But it's becoming clearer and clearer that it is the case. But it can still be hidden for a very large number of people. And I think, when you consider, as you said, it's really the credit markets, I think, is the major one. If you think about the kind of insolvencies that would be brought about by increases in the interest rate, I think that's, it's going to look like 2008 if they hadn't intervened. And so they didn't go through all of the things that they did. They didn't print all those trillions. They didn't introduce the word trillion into the lexicon in 2008 in order to just go and give up on it all right now. So they're just going to have to play around with the CPI, as they always do. And I think really when you tie this together with all of the central bank digital currency talk, plus all of the climate hysteria talk, plus all of the pandemic hysteria, COVID hysteria talk, I think we see how these narratives are very, very conducive to propagating the inflationary narrative. If you're the person benefiting from inflation, you want to push the idea that people need to stay home because of viruses and CO2 and climate. We're soon likely going to be seeing things like climate lockdowns, and we're already hearing noises about that kind of stuff. And I think we're hearing a lot of noises about raising taxes on meat and subsidizing soy and industrial produced bugs and all these kind of inferior alternatives and more expensive and cheaper alternatives. And I think that's the answer to the inflation problem. The answer to the inflation problem is not going to be responsible monetary policy. The answer to the inflation problem is you will own nothing, you will eat bugs, you will live in a tiny pod, you will not consume a lot of electricity and energy to keep your house warm, you will own a tiny souped up golf cart that can only take you around 30 minutes away from your house. When your CBDC on your wallet is functional for the 30 minutes you're allowed to leave your house because of climate lockdowns. And when you do manage to leave, your CBDC will only work for those 30 minutes in your local grocery store where you can pick up your weekly rations of soy and bug burgers. I think that's a much more effective macroeconomic strategy for bringing down inflation than, trying to do actually responsible monetary policy.
I think generally when you look at, say, the past two biggest inflationary decades in the United States, it was the 1940s and the 70s, and they did end up introducing various types of price and wage controls. That's something that they tend to resort to in those types of environments. And so I wouldn't be surprised to see those, at least in targeted areas, like some of the areas you mentioned, being introduced in the 2020s as well. And of course, there's different jurisdictions around the world. So some countries might go down that route, other countries might not. And so I do think that's something to watch as we go forward. And the CPI basket, I mean, one of the changes they made to it was they took out the direct price of homes and they put in owner's equivalent rent, which is kind of a wonky metric. And another thing, what that does is, so for example, it indirectly takes into account financing costs. And so, for example, if interest rates come down, and the home price goes up, your monthly payment can be roughly the same. And so they say, look, basically inflation's not as high as it would be if you just incorporate house prices directly, just owning the asset outright. And so there are various substitutions they do in the CPI, I think, to suppress it. I've done some analysis to try to, I know that there's like these indicators that show what inflation would have been in other ways of measuring it. And I've kind of done some of my own analysis on just kind of sorting that out. One of the challenges is that if, going back to something like, say, Jeff Booth's work, right? So the underlying technological process is deflationary. So prices should be going down for most goods and services. And so let's say you have 2% inflation, you don't really have 2% inflation. You're not measuring from zero, you're measuring from some negative number that is changing over time and it's hard to define. And that's also part of the reason why. So I've done charts where, going back to the money supply thing, where I've charted broad money supply compared to CPI. And I use 5-year rolling periods rather than 1-year rolling periods, because a lot of analysts like do look, there's no 1-year correlation between them, and it's like, well, sure, because sometimes you're working with a lag in terms of that money supply trickling is through the economy, and so it's a lot more clear when you look at 5 or 10-year rolling periods that gives that time to sort through. But even then, you see periods where sometimes you have a tighter correlation than others. And usually the periods where you have less correlation, it's because you have some big boost in productivity. So for example, in the United States in the late 1800s, you had abundant land, you're spreading out. Obviously, indigenous peoples didn't benefit from that, but you had basically this large expansion and this a big opening of natural resources. You had discovery of oil throughout the United States. You had electricity. You had this big boom in technology and abundance. Same thing in certain periods, like in Australia in the 90s. The rise of Asia around it was a very kind of booming and abundant period for it. Globally, the whole world kind of benefited from China and ex-Soviet Union countries kind of opening up over the past 30 years, kind of bringing all this fresh labor into the global market. And so you have these periods where you can get a temporarily decoupling from money supply and price increases because you've tapped into some sort of new abundance, either technology or labor.
Increase in productivity, basically. So more
Exactly.
deflation. Yeah.
Exactly. And so people then have recency bias and they go back and say, look, I mean, we solved inflation, it's fine now. And then the problem is you kind of run out of that extra, you're kind of drawing from a battery of extra productivity. And then if you continue with those monetary policies, then you start getting inflation, price inflation. And so that's why I think part of the reason the 2020s are going to be different than the 2010s, partly it's because the monetary policy itself is different. It's broad money supply going up, not just base money. And then two, we're just in naturally a tighter regime here in terms of our ability to tap into global labor and the whole natural resource cycle that we're going through.
Yeah, I think so, and I think I agree with that. I think the Jeff Booth makes a great point that productivity should be putting us negative on this kind of measure. So it may work out nicely because you then get only a 3% CPI, but that's 2% and 5% or 3%. All these numbers are just in the aggregate, and they hide the enormously destructive and redistributive impact of this tax. And it's the most regressive tax, really, because the people that are the most, that benefit the most from inflation, ultimately, as I discuss in detail in my next book, my new book, The Fiat Standard, the people that benefit the most in a fiat system are the biggest borrowers. The biggest borrowers are the ones who have the biggest short positions on the dollar. And so as the fiat currency is declining in value, the bigger your short position, the more you benefit. And so who are the biggest borrowers? Well, it's the government, and it's the big banks, and it's the big corporations. It's not the average Joe. 50% of the population that's unbanked is unable to benefit from the inflation regressive tax. They are the ones that are essentially paying it because they can only string together small little amounts of savings. So
one of the tricky things there, just to touch on that point, if you look at, say, breakdown of different wealth demographics, right? So the bottom 50%, like the next 40%, the next 9%, and then the top 1%. It's challenging because if you look at, say, debt to asset ratios, the lower you go, the higher debt they have relative to assets. So in some cases they are actually net borrowers compared to the top 1% that is some of them in real estate are kind of net borrowers, but overall they have actually a higher asset to debt ratio. But the challenge is that not everybody has access to the same rates. And so, for example, in the bottom 50%, a lot of that's credit card debt. And if you look at credit card debt, they're not benefiting from, that's almost unchanged over decades. And so there's kind of it's not, people like to break it down in terms of income groups, but it's really about types. And so, for example, there are people right in the middle that are really benefiting from it. If you have a low fixed rate mortgage, you have a house, you're benefiting from that debasement. You might be working class, might be middle class. Then there are some other wealthy people that are maybe these older retirees that have a lot saved up in bonds and pensions, and they're paid off their debt and they're getting devalued. And so it doesn't cleanly break along income groups. It's really about what type of assets and what type of liabilities. And the big challenge is that, even the people near the bottom of the income ladder that actually do have higher liabilities to asset ratios are not fully benefiting from that in an inflationary environment because their interest rates are higher than the corporations and government and wealthy borrowers.
Yeah, and they pay a very high interest rate, which essentially negates that. And then I think the other thing is that there's, the people below that are unable to access any credit. They are the unbanked, and so they have zero credit. They only have physical cash as savings. And this might not be as common in a place like the US, but it is very common across the world. And I think the other thing to add to your point about why the inflation is different right now, we could look at the previous 60 years, 70 years from the end of World War II. Not only was the dollar supply growing, but also demand for the dollar was steadily growing. The US government was constantly finding a new stream of bag holders for their dollars from all over the planet. By hook or crook, they managed to get a lot of dollars held in a lot of treasuries of governments, individuals, corporations all over the world. And that's only really been increasing over the 20th century because, monetary economics is a winner-take-all phenomena. And so the nature of the system is that everybody wants to hold the dollar because the dollar is the most liquid. Now, governments try and keep their own currency so they can maintain their seigniorage. And then that causes all of these imbalances where all of these currencies are, used to finance governments, but then used also to hold value. And ultimately, the winner in this game ends up being the dollar. Everybody wants to hold dollars. So first we had in the 70s, we had the US actively getting Japan and Germany to buy a lot of treasuries in order to alleviate that. So that's an enormous amount of dollar demand going to these two major rising economies. In the 2000s, that shifted to the Chinese. So anytime a new large economic power rises, they can only rise by buying up treasuries. They need demand for dollar. They buy dollars, they buy treasuries. The same happened in the Gulf. And, the collapse of the Soviet Union led all of these countries to go into the dollar system and start demanding more and more dollars. And then all of the hyperinflations that happen all over the world, before El Salvador went on Bitcoin, they went on the dollar because they had destroyed their local currency with hyperinflation. And many countries have done that around the world. And, we see dollarization happening in that case officially, but we also see dollarization happening unofficially in places like Turkey and Lebanon, where everybody wants to hold US dollars in whichever way they can get it. So we've had an enormous amount of demand increase in the dollar. And I think this is likely to continue for a while, because if the dollar is not looking good and if the dollar is inflationary, spare a thought for other national currencies. But perhaps what's different now is that there aren't any more big Chinas or Soviet Unions to come and, buy major bags. Everybody's bags are largely full of the US dollar. So yeah, Lebanon, Turkey, Brazil. Yeah, I mean, there's still significant demand, but I think it's not going to be as large as China, for instance. And the US now needs another couple of Chinas to come and do the heavy lifting to take over all of that inflation.
Yeah, this is that's a really good point. It's a big theme that I've had in a couple of my articles and newsletters. And if you go back to the formation of the petrodollar system, so after they defaulted on the Bretton Woods system, when they shifted to the petrodollar system, is basically trying to replace gold at the center of the global system with treasuries, and they were rather successful with it for several decades. And what the downside of that, though, is because although it benefited the dollar at expense of most other currencies except maybe the Swiss franc and a couple others, but so it benefited the dollar. But the problem is that it forced the U.S. to run these structural trade deficits. It basically gave us a form of Dutch disease, which is something that basically the economist pointed out a while ago. Dutch disease, for people that aren't familiar with it, if a country finds a natural resource, it sounds like great news, but then the problem is it can basically kind of hollow out some of their other industries, because they basically start to get, say, a trade surplus, and it strengthens their currency, and it makes some of their other exports less competitive. And so other people that might have been happy end up getting kind of it's something outside of their control, throws them off. And so generally what we see is that when the United States kind of put the treasury at the center of the financial system, it made everybody need dollars and treasuries, and so it kind of propped up the strength of our currency relative to our export competitiveness. So it increased our imports, decreased our exports relative to each other. And so we started to get these gaping trade deficits, starting there, but really we expanded them in the 90s. We kept doubling down on that policy. And so we've kind of hollowed out our industrial base compared to many other places. And so when Japan and Germany were buying treasuries, they were the ones running these giant current account trade surpluses with us. Then it was the rise of China. So they were running these big dollar surpluses, using them to buy treasuries. That largely stopped around 2013, 2014. They decided, they publicly declared that buying treasuries was no longer in their interest. And as you point out, there's no giant replacement for that. India's not really there yet. We're not seeing it out of Africa. There's no other big power coming up to buy those treasuries. But one thing that's kept the system going partially is over the past, say, 5, 6, 7 years, is that foreigners have been buying U.S. equities. And so, for example, even ones that don't have to, they don't want they're basically just doing relative currency manipulation. So Switzerland, for example, they have a structural current account surplus. They don't want their currency to get too strong, so they print currency and they buy Apple stock, for example. They buy foreign equities, mainly U.S. denominated equities, and that kind of suppresses their currency and builds their reserves. And so one thing we've been seeing is that large sovereign wealth funds, large foreign pension funds, they've been piling into U.S. growth stocks. And the challenge now is that U.S. household equity allocations are as high as they've ever been as a percentage of their total assets. The foreign sector is very much overweight U.S. equities. And so we are kind of scraping the barrel in terms of finding new buyers for U.S. assets. So U.S. treasuries, U.S. equities, the world's kind of very heavy on one side of the ship there. It looks partially like it looked like after the 2000 dot-com era. Basically, the whole world was kind of piled into U.S. equities. And when they started to draw down those equities, you actually had a decline in the dollar, at least for several years, because everyone was kind of stuffed really heavily on one side. I think it's possible we could see a repeat of that, but it's something I'm monitoring.
Yeah, I generally think I agree with you on this, although I don't. I have a bit of a problem with the term the Dutch disease, because it sort of implies that it's something about natural resources that creates that problem. But in reality, it's not a problem of the natural resource. It's a problem of it's a problem of the currency. If you had a sound monetary system and everybody was on a gold standard, then it's not an issue if a country is exporting a lot. All that leads to is that people in that country end up with a lot of gold. This is not a very bad problem to have when gold is money, at least not when it's been demonetized into an industrial metal, perhaps.
I agree. But it's only a problem in the current regime that we've been operating under. It's not a problem inherently.
Yeah. So, and I don't think that, and it's used to sort of signify to promote the idea that a strong currency is bad, and that Switzerland, they have a major problem with their currency being bad. But I don't think that it is a bad thing for Switzerland. I think it's a bad thing for the U.S. I think, one of my favorite books is called Gold Wars, and this was really influential in me writing the Bitcoin Standard. I cited in the Bitcoin Standard and in the Fiat Standard. And in that book, it explains the kind of pressure that was put on Switzerland in order to stop its currency from appreciating starting in the 1970s. Because once the US dollar went off the gold exchange standard, so it was completely tethered from gold, the Swiss franc was still pegged to gold. And so in that kind of world, and that's why in the 1970s, everybody wanted a Swiss bank account. Everybody in the world who had money, you didn't, now people want dollars, but back then they wanted Swiss francs because Swiss francs were as good as gold. They were backed by gold and they were redeemable by gold, whereas the dollar was not. And so I think this would have been a problem for the US, but not for Switzerland. Switzerland, what could have happened is that Switzerland could have basically become the analog Bitcoin of the world in that kind of world. In the 1970s, if the Swiss had just continued to take money from the rest of the world who wants to send them their money to keep it in Switzerland with first safe storage, all that the Swiss need to do is to take your national fiat from whatever country you're in, sell it, buy gold, and stuff the gold in their massive vaults in the Swiss Alps. And eventually that just becomes the central bank of the planet. If everybody's there, Everybody's gold is there while all the national currencies are collapsing. Eventually, people in the US will be trading with one another through using Swiss bank accounts. It won't be a problem for Switzerland. I'm sure it's not going to kill the Swiss chocolate industry and the Swiss watch industry and the Swiss shoe industry. It's just going to make a lot of bankers in Switzerland a lot of very rich. And it's going to destroy the fiat monetary system in all the rest of the countries, which I would argue is very good for all the rest of the world. But it's bad for the people who benefit from that fiat monetary system.
Yeah, one of the things basically, if we say I was an exporter and we all had the system, we priced our things in gold, right? So my prices were listed in grams of gold, for example. If say the currency of my country strengthened compared to the euro, for example, I wouldn't have to worry about that too much. Whereas if I price it in dollars and the dollar gets a lot stronger relative to the euro, then suddenly I'm less competitive than my European peers, unless I cut prices in dollar terms. But then the challenge is that if I have dollar-based liabilities, it's more challenging. And so it's really that's why I say it's kind of an issue of our current regime,
Yeah.
more than just inherently. It's how we've structured it and how we've kind of segmented our currencies and how we have to match assets, revenues, liabilities, while also worrying about foreign competitors.
Yeah, it's why in the Bitcoin standard I liken this foreign exchange system to a Salvador Dali painting with all of the broken clocks. You're trying to figure out what the time is, and these crazy clocks are around you. It's kind of like trying to perform economic calculation when you have assets and liabilities in all kinds of and income streams in all kinds of different currencies as they're all shifting with one another. If only we had some kind of apolitical international money that could be sent across the internet very quickly, and nobody can control it and nobody can manipulate its price. But clearly that's too fanciful. Clearly Bitcoin doesn't fit the bill because, economists at universities have told us, right?
I think it's one of those things. I mean, obviously, I like it a lot. We're 13 years into it. It's been highly successful, and it's volatile, and that's what drives a lot of people away. And then a lot of people just don't put the time into it. I mean, when I first analyzed that, I thought it was neat, but I just didn't. It took a couple cycles until I said, okay, I actually have to put hours into this and understand this thing. And I think we're just still early on that curve, even though we're pretty far into this thing now.
Yeah. So in your writing, when you talk about the Dutch disease for the US, you say that this is a system that causes 90% of Americans to lose. 90% of Americans lose from this. Most people think of it, and I think particularly most Americans, and well, not just most Americans, I think most people all over the world think of this as being a kind of chess grandmaster move by which the US has essentially subdued all of its international opposition. Give us the case against. Why is this bad for Americans?
So I think basically we can separate, America the empire versus America the domestic economy.
Mm-hmm.
And so that was arguably a very strong move for America the empire. Basically, it was a kind of a big chess piece in the Cold War, basically to kind of control the Middle East, box Soviet Union out of it, keep the dollar in demand globally, basically use the power of the Navy to basically guarantee supply chains and kind of enforce dollar usage in the Middle East, which then if Saudi Arabia and other OPEC nations only sell oil in dollars, regardless of who's buying, the implication is that every country in the world that needs to import oil needs dollars. They have demand for dollars now. And so by using your military to basically have control over certain parts of the world, make those deals, you've now entrenched your dollar. And so we basically became the country that could print money to buy oil, whereas the Soviet Union had to still dig it out of the ground. And this is something that analyst Luke Groman has analyzed and basically said that from, say, the 70s into the late 80s, that system probably made a lot of sense. The challenge is that after the Soviet Union fell, it kind of over time became less useful. Going forward from there, the United States was stuck with a system where our currency was artificially pegged higher because of the global demand for treasuries and dollars. And so that still extended America's hegemonic reach. We could sanction countries. We had our expanded global reach, but it mainly benefited corporations that could do arbitrage. It benefited politicians. But the big losers from that system were American blue-collar workers, industrialists, people that actually wanted to make things. Basically, that Dutch disease which again doesn't have an intrinsic problem, but it does have a problem in this system, made it so that those like U.S. producers were less competitive on the global scene. And so I think overall that contributed to higher wealth concentration and these other challenges that have, mostly impacted Americans more so than say Europeans, Japanese, and other parts of the world.
Yeah, I agree entirely. I think the analogy that I like to give is it's similar to giving a teenager a credit card and telling them they can spend all the money they want and not have to worry about paying it back. I mean, it's obviously great initially for that teenager, but come back to that teenager 10, 20 years later, even if the credit card is still working, arguably they would have been better off if they'd spent their time trying to learn how to make money and how to understand money and how to be productive rather than just spending money. And I think it's in a sense what this does is that in the US the only profitable or the most profitable line of business is fiat printing, basically, which is lending. So the financial industry is where the money is made in the US, and the rest of the countries is almost coasting on the enormous productivity improvements of the 20th century to be able to buy things from all over the world without having to produce, because we can just magically make alchemy. Fiat alchemy just allows the US to conjure goods that other countries need to work and sweat for. And in the long run, I think it is destructive, because you can even if you can continue to import, it's still it's still very destructive to live in a culture where work is divorced from reward. I think this is really the bad thing about it. A lot of people work really hard, but because of inflation and because of not being beneficiaries of the Cantillon effect, they can't get ahead and they can't save and they can't be secure. And few people that don't work very hard but have the right connections manage to secure enormous amounts of wealth. And that's pretty destabilizing, and I'd say dangerous. It's not worth whatever teenagers' toys that credit card allowed you to have. You'd have been better off slugging it out as a teenager, as a broke teenager like everybody else.
Another factor is the net international investment position. And so, for example, by running these structural trade deficits, which the petrodollar basically kind of forces to happen, at least in the current structure, these other countries, people can phrase it as, we send them pieces of paper, we get real goods and services. So it sounds like we're winning. But then the next step is they take those pieces of paper and they used to buy treasuries with them, right? So they used to buy our other pieces of paper. But as I said before, they've since transitioned into buying equities. They also buy real estate, they buy land. And so basically what happens is we're basically trading our appreciating assets, shares of our company, shares of our real estate, shares of our land, for consumer goods. And so as long as we continue that trend, our net international position goes down, meaning that the foreign sector owns a larger percentage of our assets than we own of their assets. And so if you go back to the United States, 100 years ago, we were the biggest creditor nation in the world. During the Bretton Woods system, we were a creditor nation. Whereas, once we started the petrodollar system and then ran that for several decades, the line literally, we were kind of like flat for a while. Then it just took a nosedive over the past 25 years in particular, ever since the 90s. And a lot of that's just because we're running these huge trade deficits, and then all those foreign cash flows are coming back into our capital markets. And so foreigners own a larger percentage of US stocks. They own a larger percentage of say, even single family homes and other types of real estate, land, compared to what Americans own of their assets. And so the longer that structure stays in place, that international investment position will keep deteriorating. And the only way for that to reverse is either for foreign assets to start doing way better than American assets, so it just changes their valuation, or if that eventually, basically if we get one of those reversals where the dollar weakens, then basically some export capacity can come back, but that brings a whole another host of challenges. And so I think the only way to kind of get out of that situation is to go through a rather rough period of time. And we've kind of put ourselves into that over decades.
Yep, it's time to face the tiger. there's just no escaping the reckoning of the tiger. I mean, there is escaping it if you manage to die before your children have to deal with the tiger. And that's, in a sense, this is kind of the agonizing thing. Like, I think for particularly Americans, the generation, the post-war generation, the boomers, were the ones who benefited enormously from the system, and they're many of them are not going to be around to witness its demise or to pay for its demise. But it seems, I mean, yeah, you're absolutely correct on the investment issue. The U.S. went from top creditor to top borrower, because ultimately what fiat does is capital consumption. People are consuming their capital. People are running through their capital, and they're engaging in a massive consumption binge, and that has to come to an end. There's no fortune that is too big to be spent. It doesn't matter how much capital you have, doesn't matter how much money, how much fortune there is, you can spend it. You can always spend the fortune. And I think it's an enormous amount of capital that the US has squandered. It looks great right now because now we're at the party. It's not going to look so great when you have to face the bill for the party, when the party's over.
And going back to your analogy of the teenager, one of the challenges is the whole, like, people say that phrase, like, hard times make strong men make good times make weak men, weak times make strong men. So the challenge, if you look at the manufacturing base in particular, and to kind of give a tangible example to that, if you do currency manipulation and make your exports less competitive structurally for decades, then naturally, those industries flow out of your country and into other countries. They go to Mexico, they go to China, they go to Germany, Japan, wherever the case may be. They go to all these different countries. And if that system ever stops, if you stop that engine turning and you want to turn it back, you've already kind of lost a lot of that expertise. People grow up and they think, why would I want to go into manufacturing? Why would I want to make things? I can just go to Wall Street. I can just go to software, right? They pick a couple industries that are still flourishing because they're high margin, they're not based on this currency problem. And when you actually start facing, say, supply chain issues, or maybe you don't want your biggest competitor, making your military equipment anymore, like in the case with, China makes parts that the U.S. military uses. If you want to actually reshore some of that, you've lost a lot of the expertise there, because other countries have spent decades building up that knowledge base. And part of innovation comes from making things, right? So you can innovate in other areas, but if you want to innovate in terms of mechanical, electrical, hardware type things, it generally comes when you're closer to that manufacturing process. That's how innovation happens. And so if you go back to, say during the early phases of the whole kind of COVID thing, you could see China building hospitals in 11 days. And the United States, basically, when we try to build a railroad in California, for example, it's a decade later, and the budget estimates are like $100 billion, and it just gets, we kind of lose the ability through a combination of regulatory hurdles and then just kind of know-how to build those things. And of course, there's very competent craftsmen and artisan. It's just is how widespread that knowledge is in the country as a percentage of its population, as a percentage of its GDP. As we've kind of hollowed out our ability, except for niche areas, to make things on the scale that, say, they can make in Germany, that they can make in China, that they can make in other countries.
Yeah, I think if you look at inflation across the US, one major factor that you find is that things that can be imported, things that can be put on a boat and shipped to New York and LA are very cheap in the US because you just keep buying those things with fake printed dollars. But things that need to be made domestically in the US are very expensive by global standards. And not only are they very expensive, they're also quite inferior. So getting a haircut in the US can be extremely expensive, and you're usually not getting the same bang for the buck that you would be getting in most other places around the world. Because most other places around the world, if you own a barber shop, you need to wake up every morning and go and cut hair in order to eat, basically, at the end of the day. But in the US, you get into the barbershop business, and soon enough you got a credit line, and then you start hiring immigrants, and you're just rolling over debt, and you're doing interest rate arbitrage, and you get credit, and you don't need to stay in that job as much because all of these financial opportunities exist because of cheap money that make it expensive to keep somebody just doing their job as a barber. I mean, obviously I'm being overgenerous. Perhaps barber is the bad example here, but like infrastructure I think is a great one. So the Empire State Building was built in under a year. I remember going to New York, and they're renovating the staircase for a subway station, and it's 18 months of disrupted service and walking through construction sites basically in order to just renovate the staircase. It's quite remarkable how expensive those things are. So yes, regulation is a part of it, but another part of it is just that it's really expensive, and it's something that you can't get shipped over from China. You can't just hire Chinese people in China to build you a subway staircase in New York City and ship it on a ship. You have to hire people in America, and that gets really, really expensive. That's where the inflation goes, So, of course, CPI does not factor these things. You look at the cost of building trains, building infrastructure. These are like, these are the things that don't get included in the CPI as much as cheap stuff that you can ship on a boat from China.
And if you look at, say, how different investments do in inflationary versus disinflationary regimes, to tie to that point. So during periods where inflation levels are pretty low, like say this past decade, basically there's not a lot of commodity scarcity. Things are more kind of focused on financialization. Businesses get rewarded for being asset light. Basically, if they can rent things instead of own things, take everything off their balance sheet, put it elsewhere, they benefit from that. But during inflationary periods, when you start running into supply chain issues, that's where owning your own assets becomes more useful. That's where being vertically integrated is more of a feature, and the replacement costs for those assets start going up dramatically. And suddenly, all these businesses that were trying to emphasize having high returns on invested capital, trying to be asset light as possible, that are then very expensive because people have recency bias. Those things got bid up to such high levels. When you have a regime shift towards more scarcity, towards you change the money supply, so you change demand, and then you run into demand constraints supply constraints you didn't know you had before. All those assets become far more valuable to people because they are harder to build than people thought. They're harder to replace than people thought. And that's how sometimes you get these big growth to value stock cycles, and that's where some of the expectations on inflation can be misplaced because they don't take into account the fact that, say, for 10 years you can be kind of coasting on depreciating assets. You can things that you built 10, 20, 30, 40 years ago are still serving a useful purpose, and you're saying, look how low inflation is, but it's because you're not having to rebuild and replace them. But over a long enough timeline, when you actually have to start building them and replacing them, it becomes more inflationary. And you realize that all your monetary policy and all of your policies are kind of geared towards that more disinflationary environment that you thought was permanent. And so that's I think one of the challenges the policymakers are going to run into, and that businesses are going to run into probably throughout this decade.
Yeah, and I agree entirely. All right, well, unlike the vast majority of people who talk about markets, you have the remarkable distinction and courage to put up your portfolio on your website for everybody to see, which I think is admirable because you're putting your track record out there for people to look at. And I find it particularly admirable given the caliber of one of your recent internet fights. Now, for those who are not very familiar with Lyn might be the perhaps the politest person on Twitter ever. It's almost impossible to find anything in her feed that is anything that is not substantive, that is just not getting to the to the root of the topic that she's talking about. Is dispassionate analysis always. And once she chose to look at the paper of a certain Nassim Nicholas Taleb, who's notorious in these parts of the internet, and he'd written something about why Bitcoin is going to die or something or the other. And she went through his paper and basically explained why it was a load of nonsense. And it was a load of nonsense. It's not worth getting into the content of the paper because it really was just somebody starting with the conclusion of, all right, this is going to go to zero. How do I find a way to explain that this is going to go to zero? But what I found remarkable is that, Nassim Taleb is somebody who's been writing about financial markets for decades now, and he has never shared his portfolio. He's never put up his portfolio and never shared a track record. But he's always out there looking for people who have had one bad quarter to go and savage them and attack them and explain how his ideas mean that he's correct, whereas those people are just completely clueless. But of course, those people are usually have their actual portfolios out there. So he has the advantage of being the kind of the soccer fan who's sitting on his couch drinking a beer and saying, if it was me, I would have done things in a different way, shouting at his TV, watching the players that are actually playing. But you have your portfolio up, and he went after you for things other than that, because I think it would have a comparison of portfolios would have probably been extremely one-sided for your in your favor. So tell us, what do you have in your portfolio, and why do you hold so little Bitcoin and Bitcoin-related companies in your portfolio?
So in that newsletter, that's like a newsletter portfolio. So that's not all my assets. That's like a specific portfolio that I track for that newsletter. The challenge with that platform is that they don't have Bitcoin as a holding, and they don't even have GBTC because it trades over the counter.
Okay.
And so the only way to get exposure is with stocks like MicroStrategy or the miners. And so that general portfolio, what I try to do is I do a spin on like the 60-40 portfolio, where I say, okay, let's have a diversified asset base, but let's try to find better things than bonds to hold, with most of that. And so what I do is I have a section for, say, dividend stocks. I have a section for international stocks. I replace some of the bonds with other types of assets. And I do have a segment for digital asset-related companies, mostly Bitcoin-focused companies, MicroStrategy, and the miners. But for example, in my research service, I have other portfolios that people can look into where I do use things like GBTC because that's available on other platforms, obviously, just not that particular platform. And then also I recommend Bitcoin cold storage, right? So I shared my readers back in, it was April 12th, I think, that I recommended, April 12th, 2020, that I recommended Bitcoin. And then I went and bought it on April 20th. So I buy most of mine, originally I bought through an exchange, but then I shifted over to Swan Bitcoin because they were Bitcoin only, and I liked their product offering. And so I kind of separate how I manage that particular portfolio from just total assets in general, kind of like how I wouldn't have my house listed in that portfolio, if real estate holdings, things like that. I consider Bitcoin best held as directly held property, and the best percentage I think varies depending on who it is, right? So I think for most people the answer is it shouldn't be zero Bitcoin, and exactly how high of a percentage of Bitcoin they want to go partially depends on when they bought it and how much it appreciated. And as well as things like what is their level of knowledge, what is their volatility tolerance, what are their financial goals. And so, that's one of my portfolios among several that I track for my clients.
Oh, I see. Okay. All right. So, other than Bitcoin, if somebody wanted to dabble in markets over the next couple of years, I think in general, as a little disclaimer, I think, the appeal of Bitcoin for me is that if we had a world with Bitcoin similar to what we had with the gold standard, investment would be something that people would only do when they find a particularly useful, good opportunity. It would not be a second job. Most people would focus on their own job, and then they'll take their earnings and they'll put them in the gold coin or in the Bitcoin. and they earn that money and they put it there, and and it stays earned there. It's saved. They don't have to go speculating on commodities and trying to understand Japanese monetary policy and trying to figure out what the euro is going to do and what's going to happen between Greece and Germany in order for them to keep their savings. So I think one of the appeals of Bitcoin is that it would bring us back to that world. And I think I see this already with a lot of Bitcoiners, where once you no longer have to worry because you are in Bitcoin for the long term and you trust that Bitcoin is going to do well in the long term, which it continues to do, even with all of these crashes, it's still up many multiples over the last couple of years. When you look at it this way, you have the freedom not to trade. So I'm not recommending that people go out there and trade fiat markets. Only put in fiat what you can afford to lose. But if somebody wanted to go and be reckless with fiat markets, where did you see a safe haven or an opportunity over the coming years, given all of these inflationary, stagnationary headwinds coming at us?
So generally, I find that the natural resource space still has reasonably attractive opportunities, as well as generally some of the higher quality international value type segments. So not the melting ice cubes, but the ones that actually have basically future-proof businesses that haven't really benefited from this huge increase in earnings multiples. Because as you pointed out, for basically people monetize investments as money for lack of good money. And so, in this environment where, their bank accounts yielding zero, official CPI is running at 7%, even before this disinflationary period, I mean, even over the past decade that was disinflationary, if you look at real T-bill rates or real bank cash rates, they were below zero for the vast majority of the past decade. It was mildly below zero, but it was below zero. And so because that money situation's been so weak, there's been a natural tendency to just stuff as much capital as you can into equity markets in particular. Also second homes and trophy assets and things like that. But for a lot of people, it's equity markets, and even for a lot of foreign investors, it's U.S. growth equity markets. And so if you look at valuations over time, so much capital has been shoved into them that now you can have much lower forward expected returns, even from good companies, just because their multiples are so high. And so one of the things I find is looking for equities that have not already been monetized, right? So that don't seem to have a monetary premium on top of their cash flow generation potential. And so there are certain value-oriented sectors in the United States. I think, for example, energy infrastructure. We went back before about the replacement cost, right? In an inflationary environment, having a very asset-heavy business can be useful because you have assets that are much harder to produce now than they were when those were built. And so I, for example, like some of the energy infrastructure in the United States and Canada. And when I look internationally, there are kind of, healthcare stocks. There are kind of, I think, more value-oriented type of plays, some commodity resources that I like. But I agree with you. In a perfect world, most people shouldn't have to focus on investments in order to, make money in a relatively stable way. Right now, the challenge is that cash itself loses value, generally slowly, sometimes quickly, depending on where you live. And then you have harder monies you can choose. So gold's one of them, but it has now a new risk to Bitcoin. And there's Bitcoin, but because it's so volatile, a lot of people can't afford to put all their money in it, or even half their money in it. They put a certain percentage into it. It's different for someone who put, say, 1,000 hours of research into it, super high conviction, bought it, 5 years ago. They can hold a higher allocation, whereas for a lot of people, some percentage I think is appropriate for them. And so the challenge is trying to navigate this environment and saying, okay, we're watching Bitcoin monetize in real time, but maybe you don't want to be 100% in Bitcoin. And so I go around and kind of find all these different assets that I think are likely to hold their value through, say, currency weakness, through currency transitions, through inflationary environments, and that also can survive periods of disinflation. So when the Fed tries to tighten policy and tries to kind of slow some of that down, going back to the earlier point of like the most indebted are the ones that win, that's true as long as you're it's almost like you want to be second place. You want to be as indebted as you can, but you don't want to be the most indebted because the most indebted are the ones that fall first, right? So in a liquidity crisis, you don't want to be the one that's over your skis. You want to be the one that's leaning in, but still able to navigate and kind of round the turn and get down to the bottom of the ski slope. And so I look for businesses that are benefiting from inflation, but that are also, say, conservatively leveraged, that they're not the most leveraged ones in the industry that might blow up along the way. And so that's how I generally try to find assets in this environment.
Yeah, I think that's probably wise. All right. One thing that I've noticed in your portfolio is that you have silver. So I'm gonna go ahead and pick a fight with you about silver. So I think silver is a shitcoin. I think it's been getting demonetized for 151 years now. Since, as I mentioned in the Bitcoin Standard, since 1870, when Germany won the Franco-Prussian War, they asked for their indemnity from France in gold, and so they got a big chunk of gold from France, and then they used that to go on a gold standard. So they were on a silver standard, and they were the biggest economy in the world that was on the silver standard left at that point. Britain, the US, and France were on gold, as well as Switzerland, Holland, and a few others. So most of the major economies of the world were on gold. Germany and a few others were on silver. But gold was going up in value, and silver was going down in value. So Germany decided to switch from gold to silver in 1871. And since then, at that point, the gold to silver ratio, well, the ratio of the price ratio between the two was about 13 or 14 to 1. So 1 ounce of gold could buy you 14 ounces of silver. Today, I don't remember what the exact ratio is, but it's in the 80s or 90s or around 100 or something like that is the ratio between them. So it's been a long, interminable decline in the value of silver compared to gold. And I think, silver bugs don't like to say this because they still like to think of silver as money. But I think it's completely lost its role as money in any realistic sense because, first of all, it was losing value compared to gold for 150 years. And now, gold is not even keeping up. So losing value, it's losing value even more than gold over time. And, as it loses value and as it stops being stacked in monetary quantities, and it starts going toward industry, what happens is that the stock to flow of the metal declines because now the stockpile, with a monetary metal, like gold, if we just used gold for money and we didn't use it for any industrial uses, then we dig up gold from the ground. It is part of the flow of new gold, and it goes into the stockpile of gold. So every year we're adding to the stockpile, but nothing gets taken out of the stockpile. That's what made gold such good money, because its stockpile rose so fast, and its flow, even as it rises, continues to stay very small compared to the overall stockpile, because the stockpiles are constant. They're not consumed. That's the key thing. You don't consume gold. That's what made it money. But silver is being consumed. And so when it gets used in an electronics device or when it gets used in some industrial machinery, it's effectively like going and digging it back into the ground. It's taking it out of the stockpile. And so moving the stock to flow begins to decline because the stockpile declines, and the stockpile is in the numerator. And so as it declines, it stops being a monetary metal, and then it starts becoming less and less valuable, and so then more and more people sell it. And I think the end point right now is that, if you wanted to buy $1,000 worth of silver, it needs real room. You're paying rent on that thing, wherever you're going to be keeping it, and I think it's been losing its monetary role. So, what is your rationale for using silver?
So generally, I agree with what you said. Over the long term, it's lost its monetary premium. Basically, it did have a pretty tight range for gold to silver ratio for literally thousands of years, and then in more recent centuries, it's gone to a structurally lower ratio. Generally, throughout the 2020s decade, I expect most commodities to do pretty well compared to the dollar. It won't be a straight line, but I expect probably gold, silver, platinum, oil, gas, copper, nickel, to do pretty well against the dollar. And so currently my approach is to have a rather diversified commodity exposure as part of a portfolio. I think Bitcoin will outperform all of the commodities. If you look over the long term, going back to the negative inflation thing I mentioned before, where inflation is not really measured from zero, it's measured from some negative number. The one commodity that's so far, at least pre-Bitcoin, has held its monetary premium is gold. So if you track gold versus just about any other asset, gold has outperformed. It's outperformed the average house. It's outperformed copper. It's outperformed silver. It's outperformed oil. Generally have these kind of sine waves where you have these commodities go up and down in price with the natural resource cycle. But for most of them, they have a kind of a downward sloping sine wave as priced in gold, because gold's the one asset that was able to maintain a high stock to flow ratio. Over the past decade, gold was flat, but gold has done that before. It's gone through these periods of time where it gets way over its skis, it goes way up too quickly, and then it kind of becomes out of favor for a decade or two. And so, for example, in the say the late 90s, all the way up to that 2011, 2012 peak, gold went up something like 5x. It basically massively outperformed the S&P 500, became a bubble, and then as we entered a more disinflationary decade, and the broad money supply was not going up as quickly as people expected it to, because they were focused more on the monetary base. You had this period of gold chopping down to sideways for a long time, building up a big base. And I think that, you say, absent of Bitcoin, I think the 2020s decade would probably be a remarkable one for gold compared to risk assets in general. The introduction of Bitcoin, and now the fact that Bitcoin is becoming large enough to be a macro asset, obviously challenges that. And so I think that overall, Bitcoin is the better investment than gold, and I think in the long run, gold's probably a better investment than silver. But given the volatility of kind of navigating this period, at least for people that do want that diversified portfolio, I don't think silver's a necessity. Like, silver's kind of a few percentage points in my portfolio, but I'm generally bullish on a broad array of commodities, mostly for the industrial use over the next decade, because I think the replacement cost of those mines are going to go up substantially. And I think basically this ongoing period of currency devaluation is generally going to benefit hard assets in general, and commodities are one of the few areas that most of them don't really have a monetary premium at the moment. And so I think going forward, a lot of them are pretty attractive. But I don't think they're necessary to have as part of a portfolio. But I think if someone is trying to have that diversified approach, I think, I have kind of a scattershot bullish view on commodities in general.
Yeah, it's another way of shorting the dollar, I guess.
Yeah,
That's the way to think
basically.
about it.
Basically, yeah.
All right. Stefano, do you have a question?
Yes, thank you, Saif, and thank you, Lyn, for the very interesting conversation. So my question is the following. I would say that trust in most institutions, it's very low, probably the lowest, certainly in my lifetime. We kind of expect that from Congress, but it's becoming apparent that this extends way beyond Congress. You can look at the courts, you can look even at public health officials, which seem to care more about politics than public health. So when it comes to the Fed, do you think that the Fed is an institution that we can still trust, or not? What are your opinions on that?
Well, so the short answer is no. Their biggest scandal recently was the trading, right? So I don't know if you followed it, but basically, yeah, for people that haven't, that are looking at this, a lot of Fed officials were found out to have actively traded their own portfolios while dictating monetary policy. And so, even without that, I think the institution is obviously challenged for trust issues. But now that even brings ethics into it, right? So you could be ethically, say, pure and still have a bad mission, but then if you're also ethically compromised, it's a whole nother type of level that's impacted. And so I think I think the Fourth Turning is a good book on this whole subject. And basically every few generations, we kind of our institutions become stagnant and basically just become so corrupted that they end up getting torn down and rebuilt. We go through these big generational cycles with it, and generally, when it comes to say cycle analysis, I'm not a huge fan because I just am more quantitative in how I view things. But one thing I like about the fourth turning concept is that when I look at the long-term debt cycle, so when I look at debt cycles through history, they're different than the normal business cycle. So things more like 2008 or 1929, these kind of big gigantic sine waves of structural generational debt accumulation. The big debt peaks all match up with the fourth turning cycles. And so that's kind of, for me, the quantitative backbone for that kind of helps show some of the things that are happening during those periods. We have these big gyrations in terms of power structures and policy shifts and things like that. And so the fact that we're in another fourth turning now, I think, is pretty unmistakable. You have rising populism around the world pushing back on existing institutions. And I think the Fed is just one of many institutions that are kind of being questioned in a way that they weren't for much of the prior decades. And really, this past 10 years or so, really, started to become to the forefront. So, I mean, 30 years ago, most people barely knew what the Federal Reserve did, probably couldn't have named the chairman of the Fed. And now it's just more on the minds of the public, in part because it's been more influential in terms of, managing asset prices, but also because it's part of this whole distrust that people have gained, mostly rightfully so, I think, against institutions around the world.
Thank you, Lyn. Appreciate it.
Good afternoon. Thank you. I just had a question for you. I'd like to know what your views are, Lyn, on the long-term view on decentralized finance and how you see Bitcoin as playing into decentralized finance, and how it, in ways that it would be used, how it would be used otherwise besides for facilitating payments and for being held as a store of value.
Yeah, it's a good question. I mean, I've been critical on DeFi in the sense that, a lot of it is decentralization theater. So it's protocols that are not really decentralized, that are kind of acting decentralized. And so I've been skeptical on most of those technologies. But I think there's a seed of usefulness in some of them. And so, for example, we're starting to see DeFi built on Bitcoin with things like Sovereign. I don't know if that project in particular will work out in the long run. I mean, they basically looked at some of the things that were happening on Ethereum and said, what if we do this on a stronger foundation? Generally, it's better for Bitcoin if there are more decentralized access points to it, right? So a lot of people buy on centralized hubs, and then they can take them off and basically trade them peer to peer. And any services that make it easier for people to access Bitcoin in a more decentralized way, I think is healthy, right? So, but the thing is, a lot of the DeFi stuff is based on kind of altcoin trading, casino type of speculative behavior, whereas a lot of the decentralization in Bitcoin over time has been, people using Telegram to orchestrate buys and sells, people using, escrow type of ways to transfer value. And so we've seen kind of decentralized aspects that are not these actual DeFi exchanges, things like that. They're less token based. And so I don't rule out the introduction of token based ones on Bitcoin. I think it's something I'm watching over time. I think long term, the Bitcoin network can be used for more things than just transferring Bitcoin. One of the things that Taproot enables is that Lightning will now eventually, once developers kind of keep working on it, be able to transfer other types of tokens, right? So kind of like how we see on Liquid right now, the Liquid network, you can have other types of assets that trade on Liquid, and Liquid trade is built on top of Bitcoin. They can do similar things with the Lightning network. And so you could have, say, very, very cheap stablecoin transfers through Lightning over time. You could have other types of assets. And again, I don't know if that's going to catch on because the Bitcoin community is less focused on different types of tokens and things like that. I do think that would be useful for stablecoins in this current period of time, because there is a demand for stablecoins because people want, harder currencies than their local currencies, maybe without having the volatility of Bitcoin, or at least for part of their assets. And so I am generally bullish on the proliferation of stablecoins. And generally, they were introduced on Bitcoin, they navigated towards Ethereum, then they navigated towards cheaper chains because that whole industry kind of it kind of navigates towards more centralization and lower fees. And so it would be, I think, healthy to see stablecoins come back to Bitcoin if Lightning made it super cheap for them to move around. I'm kind of going to wait and see how that works out. I mean, I'm pretty bullish on the Lightning devs. So it's something I'm optimistic about, but I don't think Bitcoin needs it. But I think some of those technologies can benefit from Bitcoin.
Yeah, controversial one on carbon. Particularly in the EU, we've got an environment where they're beginning to regulate the ability to consume carbon, particularly for energy companies, but they're also introducing the sort of carbon border adjustment mechanism, which will mean that if you don't have the requisite amount of carbon, you'll have to buy it in the market. But the price of carbon has been quite volatile. In some respects, it is becoming an asset class in its own right, where it has a restricted supply, which is maybe sort of monitored and restricted by governments. And obviously with the various regulations such as carbon border adjustment mechanisms coming in, there will be increasing demand. But I wonder whether you think that is potentially, one, an asset class, and two, what impact that might have on inflation.
So I do. So over the past year, I've tracked the European carbon market to some extent, because there's some analysts kind of pointing out that the way it was designed, it was inevitably going to be a bubble. And so that's something I've tracked, but that I've not gone as deeply into as some of those analysts have specialized on that. I generally do think it's going to be a larger asset class for a while, at least until it causes enough problems that they might move away from it. But basically, we see Europe doing it. We even see China kind of moving towards pricing carbon. And so I do think that it's going to be, in some ways, like an artificial commodity, where it's something you can buy and sell, and that market exists because of various mandates or restrictions on how much can be emitted or what you get paid for taking it. And so I think that is probably going to be a big market going forward. And it's, I think one of the challenges that I think policymakers have done is they focus so much of their environmental concerns on one variable, carbon emissions, whereas there's all sorts of other pollutants. There's mercury in the oceans, petrochemicals getting out there, right? But it's kind of this like myopic focus on just carbon emissions, and then they don't even necessarily focus on long-term things that can sequester carbon, like say high quality farming, for example, right? So like permacultures, grazing lands, there's more carbon in the soil than the atmosphere, but everything's kind of focused on that one side of it, just the emission side. And so, I don't think that market is well constructed, but I think that market's probably going to get bigger through this decade.
Hi, this has been a great conversation, both of you. I wanted to know, Lyn, if there's anything on the fiscal side that you've been paying attention to or could see coming this year. With it being Fed trying to tighten during an election year, and considering that Congress missed their huge spending bill they were trying to pass at the end of last year, and if unemployment's going to start rising during the tightening, are we going to see potentially helicopter money like we saw during COVID if unemployment goes up, or maybe we would see some politicians trying to pass a giant spending bill to help their reelection chances, or does any of this matter? Just curious if you had your eye on it.
So I do think it matters in the intermediate term. And so even though I've generally been in the inflation camp, so compared to analysts that were expecting ongoing disinflation, I've been generally expecting higher structural inflation. And it's a lot of it because other analysts weren't really focusing on the money supply, whereas I've been focusing on the money supply and those types of fiscal injections that have been responsible for boosting the money supply so quickly. But it also goes in the other direction as well. So when those fiscal stimulus packages pull back to some extent, you can get a declining inflation rate of change term. It's not like the second you stop doing those fiscal packages, inflation goes away. But in terms of watching the growth of the money supply over time, it is somewhat decelerating because the fiscal kind of stimulus into the economy is decelerating. And so the fact that they didn't get through the Build Back Better, and if they continue not to do anything this year, and then you run into midterms where you're probably going to get then a gridlock situation. One of the reasons I've been warning my clients about being cautious on equity markets since December is because the combination of Fed tightening into decelerating economy, but then also that lack of fiscal, right? So a lot of this big boom we saw over the past 2 years, this helicopter money is, the taps are temporarily off, or at least slowed. So there's still a structural deficit. There's still money supply being added to the economy from the government, but it's at a lower rate. And so I've generally been looking at a potential for CPI, headline CPI, to peak out in year-over-year terms, potentially by the end of this quarter or the early part of next quarter. And that doesn't mean it necessarily goes down to where the Fed wants CPI to be, but it means it could roll over in terms of year-over-year rate of change terms. We don't see housing prices going up like they used to. We don't see, some of these other kind of inflationary factors continue to push up at that accelerated rate. And so the funny thing is, as the Fed tightens their monetary policy, they could see inflation kind of roll over and take credit for it. Whereas I think part of it is that the fiscal stimulus is actually wearing off, and that was the key part of the inflation we experienced. And so I do think that, if you look at the 40s, we had a very inflationary decade, but it was not a straight line. And I think the 2020s are going to be the same thing, where on average it's going to be a much more inflationary decade, both in terms of money supply inflation and CPI inflation compared to the 2010s, but that it's not going to be a straight line. And so I do think that there's a risk to these inflationary positions throughout 2022, and they're probably going into the next year as well.
Thanks, Lyn. That was a wonderful discussion. I really enjoyed hearing that. My question is on the Austrian School of Economics specifically. I've been reading a lot of your work, your newsletter, your tweets and things, and your analysis is amazing. And one thing I've noticed is that sometimes in your writing, the Austrian School comes up, but it doesn't seem to be kind of central to your thinking and your explanations. And sometimes there's stuff that you write about, and I think the Dutch disease that Saifedean mentioned earlier is probably an example of something which doesn't fit into the Austrian framework, but it's commonly used in the mainstream as an explanation for why Holland had problems in the late 1950s. But I guess my question is, we obviously live in a very complicated world full of government distortions of various kinds, and we need to have a framework for making sense of those distortions. But I wanted to ask a theoretical question about your understanding of the Austrian school, which is, do you think that there are any problems with the Austrian school at a fundamental theoretical level? Are there any logical fallacies built into it? For example, if we're talking about the Keynesian mainstream school of economics, I can point to a number of specific logical fallacies, such as rejection of the subjectivity theory of value, such as the way in which they try to objectively quantify utility when making government policy. For example, in healthcare, in the UK, they have something called a quality adjusted life year, which is used to determine how much money they should spend on various healthcare outcomes. And I think that those things are built on a clear set of logical fallacies. So my question to you is, do you think that the Austrian school has any theoretical problems? And then I'd also ask Saifedean to maybe respond to what you say. If you do think there are some, then maybe Saifedean could provide an explanation of whether he sees that as a logical problem or whether he thinks there's an explanation for why it is.
It's a good set of questions. And so my overall view is that I don't really view Austrian School of Economics as having any sort of structural fallacies to it. I think it's generally the best, out of the schools of thought out there, it's the best set of tools, I think, to approach how macroeconomics work. If there's a shortcoming to it, I think it's simply that because of the policies in place over the past 5 decades, it hasn't been very informative for a lot of investors in any sort of near-term or intermediate-term application for market outcomes. And so, for example, if I were to refer to an economic school that I think has been useful for, say, investment performance over the past few decades, it'd be monetarism. And so, for example, one of the critics of Bitcoin is Steve Hanke, the economist. But one thing he's very good on is inflation, because unlike other economists, he focuses a lot on money supply growth. And so he's been rather accurate in terms of forecasting inflationary periods. That's been one of his strengths because his School of Economics focuses heavily on that. And so I think that in this current regime, that school has been useful. Whereas I think the one that has the most sound underpinnings to it is the Austrian School of Economics. So I think it depends on what time frame you're looking at and what you're specifically trying to do with it. And so I think some individual Austrian economists have fallacies, but the underlying foundation, in my view, doesn't. And only becomes an issue when people try to make claims about markets in, say, a 5 to 10 year period that are, they're missing certain variables. They're assuming that, say, the money supply inflation is happening, therefore you have to have price inflation, and they're not taking into account that there are other factors that can cause it. But that's not an issue with the school itself.
Yeah, just to respond briefly to that before Saif. That's the way I tend to explain it, because within Austrian economics, you have certain concepts which are simplified concepts. So, for example, we would assume that money, the medium of exchange, functions in a particular manner, and then we would come up with an macroeconomic variable, such as M1, M2, M3, and we would say, in our analysis, this thing equals money. When in reality, what money actually is functions very differently depending on the variable you're talking about, depending on the instrument you're talking about, whether it's a debt instrument like US Treasury, whether it's base money, whether it's credit within the banking system represented by M2. And so sometimes what I see is that we make the wrong connection between real world macroeconomic variables and what we align to the Austrian theory. Whereas people say that's a refutation of Austrian economics, but actually it's a refutation of some of the assumptions. And so that's probably how I see it, but I'd be interested to hear what Saif's view is.
Yeah, I think I agree with it in general. I think, day-to-day market calls, the way that I think about it is that in this current market with fiat money, the ability of governments and central banks to manipulate outcomes means that, predictions of certain market outcomes in the short term or the medium term is pretty much an exercise. It's not economics. It's an exercise in trying to understand the politics and the psychology of the people that are making decisions. So are they going to tighten or not? That's going to be a more important question over the next year than anything else that happens. Well, perhaps not anything else. We get another pandemic or another world war. That's probably going to be a little bit more important. But, barring a giant pandemic or a world war, the most important thing is going to be what these people in positions of power are going to decide to do. So that's in this kind of extremely manipulated market. I think it's economic theory can only go so far, and trying to understand economics can only really go so far. And I agree in terms of monetarist, in terms of the money supply. Yeah, and then that's also, I'd say Austrians would agree with that. Increase the money supply, you would expect to see an increase in prices. But the Austrian perspective is I think more nuanced in that regard. If you read Rothbard's America's Great Depression, his book might just have the best explanation of the business cycle. I've always used to say that, and recently somebody showed me a quote by David Gordon saying that Hayek had once told him that he also thought that was the best explanation of the business cycle. So in that book, Rothbard makes it clear that inflation, increase in the money supply, which is the Austrian definition of inflation, doesn't just materialize in increases in prices of consumer goods. It also reflects on assets and inflation in assets. And in the 1920s, that was the stock market bubble, which you can, from the Keynesian perspective, this is just an entire world that doesn't exist. Monetary policy doesn't cause bubbles. In stock markets, stock markets are always reflecting fundamentals, and if they fall, it's because the government didn't spend enough money and didn't print enough money. All right. Well, Lyn, thank you so much. I know you're braving a cold, and you've humored us for almost 2 hours of your time. Really appreciate it. Thank you very much. This has been extremely informative, and I hope we'll have you on again and again, and hopefully things will be more orderly in the world. But I guess that's a bit of a wishful thinking at this point.
Yep, thanks for having me, and I'm always happy to have the discussion. I think we touched on a bunch of different topics here, so that was very useful.
Thank you. Cheers. Have a good day.
You too.